Welcome to the Deep Dive. Today, we're exploring something I think many of you probably dream about.
Oh, yeah. What's that?
Well, it's this really enticing idea of retiring, as a full-time private investor.
Living comfortably just by putting your money into stocks you picked.
Exactly. That ultimate freedom.
Sounds pretty good.
So let's set the scene a bit with the classic 4% rule. Imagine someone, let's call him Tom. He's 43, an engineer, and his yearly living costs are, say, $37,000.
Okay.
Now, Tom's been really diligent, saved and invested for 2 decades,
Yeah.
right? And he's built up a $1 million portfolio in the stock market.
Wow, that's some serious saving.
It is. And now if he gets just a 4% net return each year from those investments, which is, pretty attainable,
Yeah, historically reasonable.
that gives him $40,000 a year.
Which more than covers his $37,000 expenses.
Got it.
A little buffer, too.
Exactly. So maybe on his 44th birthday, Tom decides that's it. He leaves the 9 to 5.
And starts living the dream.
Yeah, spends his time doing what he actually enjoys, like really getting into investing, hiking, maybe some tennis, and, well, most importantly, more time with his family.
That's the goal for a lot of people, isn't it?
It really is. And what's great for this deep dive is that our source material is this fascinating book. It's called Free Capital: How 12 Private Investors Made Millions in the Stock Market by Guy Thomas.
Sounds interesting. Free capital.
Yeah, and it looks at a dozen successful private investors who did pretty much what our fictional Tom did. They retired midlife.
Okay.
But here's the really inspiring part, I think. The author says they don't seem like superhumans.
So it feels attainable. Not just for, Wall Street wizards.
Exactly. It suggests that maybe their success is something more of us could potentially aim for.
Okay, I'm intrigued.
So our mission today is basically to unpack the top 5 takeaways from this book.
All right, let's do it. It's quite something how these, seemingly ordinary folks manage to build that kind of freedom. Makes you think about the actual steps,
Absolutely. And that brings us right to our first key insight. Don't dig too deep. Focus on the crucial drivers.
Okay. Less is more, maybe?
Sort of.
Yeah.
Let's go back to Tom. He's gotten pretty good at cutting through all the information overload.
A useful skill in investing.
Definitely. So let's say he's looking at a fictional company, maybe a plant-based beef business called DeBeef.
DeBeef. Yachi.
Huh. But Tom doesn't, spend ages sifting through every single data point. If he sees it's got an attractive valuation compared to his past earnings, its cash flow, he might just buy the shares.
Right. So not endless analysis paralysis up front.
No. And then his focus shifts. He just watches a few key things, the drivers that will really, make or break DeBeef going forward.
And identifying those core make or break drivers, that's the real trick, isn't it?
Seems like it.
So for a company like this DeBeef Dime, Tom would probably monitor its pricing power. He'd look in the annual reports for that.
Pricing power meaning?
Can they raise prices without losing tons of customers? It shows if they have a strong competitive edge,
Right. Makes sense.
And then maybe if his whole reason for investing is high growth, he'd watch, say, how many new restaurants they're adding compared to what they're spending on sales and advertising.
To see if that growth is efficient or getting super expensive.
Exactly. If growth costs more and more, he needs to know that right away. It's not just what they look at, it's also about, ruthlessly ignoring almost everything else.
That's disciplined. And it's interesting, this approach, focusing on core drivers, it's echoed by, the biggest names. Warren Buffett, for instance.
Yeah.
At a Berkshire meeting back in '98, he basically said, figuring out Coke's future boils down to just 2 things.
Let me guess. Sugar content.
No. It was the number of cases sold and the earnings per case.
That's it.
Simple. And same for Jayaco, he said. Insurance policies in force and the underwriting experience per policy. Just the essentials.
Yeah, and that really comes through in the Free Capital book, too. It seems to be a common thread for these investors. They actively filter.
Skip the noise.
Right. They skip all the excessive details and just hone in on the few trends, the few figures that genuinely matter.
Because trying to track everything
means you end up giving everything equal weight, even though maybe only 2 or 3 things are really critical. It's inefficient.
An opportunity cost to all that digging.
Exactly. This focused approach, not endless digging, that seems to be where the real edge is found. The devil is rarely in the details.
Devil is rarely in the details. I like that. It's a powerful shift in perspective.
It is.
But, okay, focusing on the right things. It doesn't mean the path is always going to be easy, does it?
Oh, definitely not.
Which brings us nicely to our second big insight. Enjoy the hardship. Embrace mistakes as learning opportunities.
Ah, yes, the enjoy the hardship part. Easier said than done sometimes.
Tell me about it. But let's be real. Investing successfully. It's often tough. Major setbacks happen, even to the experienced, wealthy investors in this book.
Absolutely. And, it reminds me of the Dunning-Kruger effect.
No, explain that.
It's that cognitive bias where when you're new to something, you tend to overestimate your ability, your competence.
Like, you don't know what you don't know.
Exactly. And this really shows up in investing. You might have some early luck, maybe the whole market's just going up.
The bull market.
Right. And you think your strategy is brilliant, but really, it might be flawed. As the saying goes, don't confuse brains with a bull market.
Yeah, that's a good one. And Charlie Munger, he had a quote about this too, didn't he? Something like,
It's not supposed to be easy. Anyone who finds it easy is stupid.
huh? Classic Munger. Blunt.
But true, right? The critical thing, especially early on, isn't necessarily chasing huge returns. It should be about learning, understanding risk.
Because you can't get good risk-adjusted returns if you don't even see the risks properly.
Precisely.
Huh.
Which is why, counterintuitively maybe, making some big mistakes early on, when your portfolio is probably smaller, that's actually incredibly valuable.
Better to learn those lessons with less capital at stake.
Much better than years down the line when the numbers are way bigger. So if you're finding it tough or you've had some recent losses, remember that's kind of normal, expected even.
It's part of the process.
Yeah, this hardship, this struggle, it's what sharpens your thinking, makes you try harder, figure things out. Think about it. If investing was easy, the opportunity wouldn't last long, would it? Everyone would do it and the returns would disappear.
That's a really good point. It reframes setbacks completely.
Yeah.
Okay, so we've talked focus, we've talked embracing hardship. Let's shift gears a bit from the how to the why.
Motivation.
Yeah, which leads to takeaway number 3. Reach for freedom. Prioritize long-term goals over short-term consumption.
Oh, this is a big one.
It seems for these wealthy investors in the book, the main goal wasn't just, buying more stuff. It was fundamentally about gaining freedom.
Right. And if you think about that big picture, living off your portfolio, one of the easiest ways to mess that up is to interrupt compounding.
Like taking out big chunks of money too early.
Exactly. Making large withdrawals for, fancy cars or whatever before you've actually reached your financial independence goal. Munger had something on this too.
He's everywhere today.
It seems like it. He said, the first rule of compounding is to never interrupt it unnecessarily.
Never interrupt it unnecessarily.
Powerful. It really highlights that trade-off, doesn't it?
I doubt.
Like, you see someone driving a flashy Lamborghini, looks like they've made it, right?
Sure, that's the image.
But the book makes this point. You're also looking at someone who is effectively a Lamborghini pourer.
Ooh, that's a stark way to put it. Hits home.
Yeah. It's that immediate gratification versus the long-term goal, your portfolio growing, getting you to retirement, to freedom. You have to ask yourself, what's that trade-off really worth to you? And what's interesting, kind of counterintuitive, is that if you focus on achieving that freedom first, you might actually end up being able to afford more consumption later on anyway.
So delaying gratification can lead to more gratification.
Potentially, yes. It's like having your cake and eating it too. But, and this is the key, only if you have the patience, the perseverance to wait, to stay a little hungry for a while.
Perseverance seems crucial. Absolutely. Okay, moving to our 4th point. Focus matters. The power of concentrated portfolios.
Portfolio construction.
Exactly. When you look at how these successful private investors actually structure their investments, there's a pattern. They often run fairly concentrated portfolios.
Meaning fewer holdings?
Yeah. The median investor in the book held fewer than 10 companies.
Fewer than 10. Wow, that is quite concentrated for many people.
It is, which makes you wonder why. Why not diversify more broadly?
Well, Warren Buffett, again, he had his famous analogy, the harem of 40 women.
Right, I remember this one.
His point was, if you have a harem of 40 women, you never get to know any of them very well.
Okay. Apply that to stocks.
His thinking is that building a portfolio is about finding stocks likely to do better than the overall market, right?
Sure.
So once you've put in your, say, 10 best ideas, what happens when you add your 11th best, 12th best, all the way to your 40th best?
Your returns get diluted by the less good ideas.
If your strategy truly has an edge, yes. Adding more and more ideas just waters down the impact of your best ones.
Okay, that makes sense from a return perspective. But what about risk? Isn't the standard advice to diversify away risk? People worry concentrated portfolios are too volatile.
That's the common critique, yeah, that your portfolio value will swing around too much if you only own a few things.
So how do these investors square that?
Well, first, many would argue that volatility isn't the same thing as fundamental risk, the risk of permanently losing capital.
Okay, fair distinction.
But even just looking at volatility, the data shows that the up and down swings of a stock portfolio actually decrease significantly once you had about maybe 7 different companies.
Oh, really? So the benefit of adding the 8th, ninth, 10th purely for volatility reduction is much smaller.
Much smaller, yeah. So that specific argument about excessive fluctuation often doesn't hold up as strongly as people think beyond, say, 7 to 10 stocks.
Interesting.
But a word of caution is definitely needed here. While experts like Buffett might occasionally put 40% or even more into a single stock,
Whoa.
that level of concentration can be psychologically really tough for someone less experienced. The swings are bigger, even if the diversification benefits plateau somewhat.
So it's about knowing yourself, too.
Absolutely. For a beginner, maybe the most important thing is just staying invested, staying in the game, not necessarily shooting for the moon with hyper concentration right away.
So maybe start smaller with concentration.
Yeah, maybe you increase concentration gradually. Start with smaller amounts in your highest conviction ideas, build comfort. Or focus your concentration where you have a real edge, like deep knowledge from your job or a serious hobby. That gives you an informational advantage that can justify holding fewer names.
That's really practical advice.
Mm-hmm.
Okay, that distinction is key, which leads us perfectly to our final takeaway, number 5. And it feels like the most personal one. What makes you tick? Develop a personalized investing strategy.
Ah, the tailoring part.
Exactly. It's all about building an investment approach that fits you, your unique skills, your personality, your job, your interests.
Yeah, this is so important because what works brilliantly for one person might be a total disaster for another, even if the strategy itself is sound on paper.
How so? Give me some examples.
Okay, well, think about your background. If you're an engineer, maybe a quantitative, numbers-driven approach feels natural, right?
Sure, spreadsheets and data.
But what if your background is in, say, art? Or maybe you worked in customer service for years. Perhaps then a more qualitative approach works better for you, focusing on the company's story, its brand, its customer loyalty.
Kind of like Peter Lynch's idea. If you like the store, chances are you'll love the stock.
Exactly. Leaning into what you naturally understand and connect with. And personality matters hugely too.
How?
Well, are you an extrovert? Maybe going to lots of annual shareholder meetings, talking to management, networking. Maybe that gives you energy and real insights.
Okay.
But if you're an introvert, the thought of that might be totally draining and stressful. You might do better analyzing things quietly on your own.
Or maybe your job is just crazy demanding, like 80-hour weeks.
Right. In that case, maybe trying to pick individual stocks is just unrealistic right now. Perhaps the best strategy for you at this moment is setting up a simple, automated index investing plan and focusing on your career.
So it's about being honest with yourself about your time, your energy, your temperament.
And crucially, what actually interests you.
Ah, yeah, that's key for sticking with it, isn't it?
Totally. You have to spend some time figuring out what genuinely grabs you. Don't force yourself into a strategy that uses methods you find incredibly boring.
Because you'll just give up eventually.
You'll never have the endurance for the long haul. So what kind of investing actually excites you? What do you enjoy learning about?
And finding that might take some trial and error.
Oh, almost certainly. You'll probably explore a few different paths. It's interesting, the source mentions one of the investors started out as an IPO arbitrager.
Trying to profit from those initial price pops when companies go public.
Yeah, or as they actually called themselves, maybe more accurately at the time, an IPO loss generator.
Huh. Okay, so it didn't work out initially.
No, but they evolved. And the chances are pretty high that the first method you try won't be the one that ultimately builds your wealth. You learn, you adapt.
So it's a journey of discovery, too.
Definitely. Which brings us back to some of those great summary points from the source material. Things like, all metrics are not created equal. Find the vital few.
Right. And we're all beginners. At some point, enjoy the learning process.
Yeah.
Embrace that hardship we talked about.
Exactly. And don't sacrifice long-term happiness for short-term vanity, that Lamborghini point.
Focus on freedom. Be picky with your investments. That concentration idea.
Mm-hmm. And finally, remember, testing leads to failure, and failure leads to progress. You have to try things, see what works for you.
That's a great summary. So just to quickly recap our deep dive on free capital,
Mhm.
it seems the path to financial freedom these investors took involves, well, discipline, definitely.
For
A
sure.
real laser-like focus on what's essential, and maybe, above all, finding an approach to investing that is deeply personal.
Well said. It's not just about finding the right stocks, but finding the right way for you to invest.
Absolutely.
And maybe a final thought for you to consider beyond just what we've discussed. As you think about your own path, think not just about what you'll invest in, but maybe also consider how the very act of investing, this whole process, how that will shape your own understanding.
Keep your understanding of.
Of risk, certainly. Of patience, definitely. But ultimately, maybe how it shapes your understanding of yourself. Because in this investing journey, progress isn't only measured by the size of your portfolio, it's also measured by your personal evolution along the way.